The world of investing offers countless vehicles to grow your money, but two of the most commonly used assets are ETFs, exchange-traded funds, and stocks. While both are bought and sold on stock exchanges and offer opportunities for financial gain, they represent very different concepts in terms of structure, purpose, risk, and performance. Confusing the two, or using one in place of the other without understanding their key differences, can lead to mismatched strategies and disappointing outcomes. Whether you're new to investing or refining your approach, understanding how ETFs and individual stocks differ is essential to building a well-rounded portfolio. This video breaks down the top 10 important differences between ETFs and stocks in simple, practical language. 1. Definition and composition. Stocks represent ownership in a single company, giving you a direct stake in its assets and earnings. When you buy Apple stock, for example, you own a piece of Apple Inc. ETFs, on the other hand, are baskets of assets, typically a collection of stocks, bonds, or commodities, grouped together and traded as a single security. Buying an ETF is like buying a small piece of an entire portfolio. For example, an S&P 500 ETF gives you exposure to 500 companies in one trade, offering built-in diversification that a single stock cannot match. 2. Diversification benefits. A single stock offers no diversification. Your investment is tied to the fate of one company. If that company underperforms or collapses, so does your investment. ETFs spread your risk across multiple holdings. Even if one or two companies within the ETF perform poorly, others may offset the loss. This makes ETFs particularly valuable for beginners and risk-averse investors who want exposure to sectors, indices, or asset classes without betting on one company's success. In short, stocks can be high reward but high risk, while ETFs offer balanced exposure. 3. Volatility and risk profile. Individual stocks are typically more volatile than ETFs. A stock's price can swing wildly based on quarterly earnings, CEO decisions, scandals, or product announcements. This makes stock investing more speculative and often more stressful. ETFs, with their broader base of assets, tend to have lower volatility and smoother price movements. While they can still be affected by market swings, their diversified nature cushions them from sharp declines caused by single company events. If you're looking for stability, ETFs tend to be the more consistent option. 4. Active versus passive management options. Stocks are inherently an active investment. Buying and managing stocks usually requires time, research, and regular evaluation of the company's fundamentals and market performance. ETFs, by contrast, come in both passive and active forms. Most ETFs are passively managed and track specific indices, e.g., S&P 500, Nasdaq 100, meaning there's little need for active involvement once you invest. However, there are actively managed ETFs where fund managers buy and sell assets within the fund to beat the market, giving you options based on your investment philosophy. 5. Trading flexibility and liquidity. Both stocks and ETFs trade throughout the day on major stock exchanges, allowing you to buy or sell them in real time at market prices. This makes ETFs much more liquid and flexible compared to mutual funds, which only trade at the end of the trading day. However, individual stocks may offer more liquidity in some cases, especially if they are from large, widely traded companies. Smaller or specialized ETFs might have lower trading volumes, resulting in wider bid-ask spreads and slightly reduced liquidity compared to blue-chip stocks. 6. Dividends and income generation. Many individual stocks pay dividends, typically on a quarterly basis, depending on the company's earnings and dividend policy. ETFs can also pay dividends if the underlying holdings do, but these dividends are usually pooled and paid out on a regular schedule, monthly or quarterly. ETFs that focus on high dividend companies can serve as an income-generating investment, just like dividend stocks. The key difference is that with ETFs, you're receiving a blended dividend yield across multiple companies, while with a stock, your yield is tied solely to one firm. 7. Cost and fees structure. Buying and holding stocks generally incurs no ongoing management fees. You may pay a small trading commission, depending on your broker, but once you own the stock, there are no further costs. ETFs, however, come with expense ratios, Annual fees charged by the fund manager for managing the ETF. These are usually low, often under 0.10% for major index ETFs, but they can add up over time. Actively managed ETFs tend to have higher fees. Still, for many investors, the cost is justified by the convenience and diversification ETFs provide. 8. Research and time commitment. Investing in stocks requires deep individual analysis. You need to understand the company's financials, industry trends, earnings potential, and competitive positioning. That means keeping up with news, annual reports, and market performance. ETFs reduce the research burden significantly. Instead of researching each company, you just need to understand the ETF's objective, holdings, and performance history. For investors who don't have the time or interest to monitor individual companies, ETFs provide a hands-off solution that still aligns with sound investing principles. 9. Portfolio role and strategic use. Stocks are best used when you have high conviction in a particular company's growth potential. They can be great for aggressive growth strategies, where you aim to beat the market by picking winners. ETFs, in contrast, are often used for asset allocation, diversification, and market exposure. They can serve as the foundation of a portfolio or fill gaps by offering exposure to specific sectors, countries, or investment styles. For example, an investor may hold a mix of broad market ETFs and supplement with a few individual stocks to pursue higher returns. 10. Tax implications and efficiency. Stocks are taxed when you sell them for a profit, capital gains, or receive dividends, ordinary income. ETFs are generally more tax efficient, especially those following passive index strategies. Thanks to an IRS rule known as the in-kind redemption process, ETF managers can remove appreciated securities without triggering taxable capital gains, which is not possible with mutual funds or individual stocks. This feature allows ETF investors to delay or minimize taxes, making them a smart choice for taxable accounts. Actively trading stocks, on the other hand, may generate frequent taxable events. While both ETFs and stocks play important roles in the investment world, they serve different purposes and appeal to different kinds of investors. Stocks offer the potential for high rewards but come with higher risk, time commitment, and volatility. ETFs, on the other hand, offer simplicity, diversification, and lower volatility, making them ideal for those who want to invest efficiently with less effort. Knowing when to use one or the other, or how to combine both in a balanced strategy, can help you achieve your financial goals while managing risk effectively. By understanding these top 10 differences, you'll be better equipped to build a smarter, more resilient investment portfolio.